If China keeps dumping US Treasuries, who exactly is left holding the bag? Because the number floating around right now is wild. China is sitting at roughly $688.7 billion in US Treasury securities as of October 2025. That sounds huge until you realize it used to be over $1.3 trillion at its peak. So the real story isn't China owns America. The story is China spent a decade as the biggest foreign creditor, and then quietly started walking out the side door. And if you're watching from the US, the UK, Canada, Europe, Australia, basically anywhere in the Western world, this matters to your mortgage rate, your credit card APR, your stock portfolio, and your retirement account. Today we're breaking down the headline, China's $688 billion exit. Is the US dollar losing its grip? Quick disclaimer, this is education and commentary, not financial advice. I'm not telling you what to buy or sell. I'm showing you the mechanics so you can think clearly. All right, let's tell the story the way the market actually feels it. What does China's exit actually mean? First, let's translate the viral claim into plain English. When people say China's $688 billion exit, they're usually pointing to China's reported treasury holdings falling to about $688.7 billion in October 2025. The big picture is the drawdown from the top. China hit an all-time high around $1.3167 trillion back in 2013. Do the math and you get a reduction on the order of roughly $600+ billion. That's not a trade. That's a decade-long strategic unwind. Now, two important details so we don't oversimplify this. One, China here is mostly China mainland, as the US Treasury reports it. Two, some treasury exposure can be held through custody centers and intermediaries, which makes the true footprint harder to read from one table. So yes, the exact number can be debated, but the direction isn't. The trend is down, and it's been down for years. Now, the next line you always hear is, they're selling at a loss. That part is mostly true, but you have to understand why. The loss. That isn't a mystery. A bond is basically a promise. You lend money, you get paid interest, and you get your principal back at maturity. Here's the catch. Bond prices and interest rates move opposite. So, when the Federal Reserve hiked rates aggressively, older bonds with lower interest became less attractive. If a bond pays 1% and the market now pays 4% or 5%, nobody wants your 1% bond unless you sell it cheaper. That's the loss. If you hold to maturity, you can still get the face value back. But if you sell before maturity, you accept the market price right now, which can be below what you paid. So when China sells in a high-rate world, they're basically saying, I don't care about squeezing every last penny out of this bond. I care about getting out. I care about liquidity. I care about optionality. And this is where it stops being a finance story and becomes a geopolitical story. Why China is really doing this? There are three big motives people keep circling, and they all stack on top of each other. The dollar became a weapon. Paper claims are being swapped for hard assets. Selling dollars helps defend the yuan at home. Let's go one by one. The dollar as a weapon. If you want to understand China's mindset, you have to rewind to 2022. After Russia invaded Ukraine, the US and its allies moved to freeze a large chunk of Russia's central bank reserves held in the West, on the order of $300 to $350 billion in reserves exposure, with most frozen assets concentrated in Europe. That moment was a global alarm bell, because central bank reserves are supposed to be the break glass in case of emergency money, the stuff you can use when everything is falling apart. When those reserves can be frozen, the message to every major country was simple. Your dollar assets are only yours as long as the political relationship stays friendly. So from Beijing's perspective, treasuries are not just safe, they're sanctionable. And you don't need to be under sanctions today to plan for them tomorrow. You plan when it's quiet. That's why you'll hear the phrase sanctions proofing. Not because China thinks sanctions are guaranteed, but because if you're running a superpower, you don't wait for guaranteed. Paper claims versus hard assets. When you hold treasuries, you're holding a paper claim on the US government. It's liquid, it's deep, it's the biggest market in the world, but it's still a claim. If you're a government thinking in decades, you also want things that don't depend on someone else's promise. Gold, commodities, supply chains, real resources, and here's a concrete data point. The World Gold Council noted that China's central bank reported gold purchases in 2024 totaling 44 tons, and continued adding in early 2025 as well. Now, gold isn't in the IMF COFA reserve breakdown the same way currencies are, but psychologically gold is the I don't trust you asset. It's the asset you buy when you want a reserve that's harder to freeze, harder to politicize, harder to cancel, and gold isn't the only angle. Industrial commodities matter too. Copper, oil, and yes, silver. because those are inputs into power grids, military hardware, EVs, chips, and everything modern. So if you zoom out, the pattern looks like this: less paper, more stuff. Defending the yuan. This part gets ignored because it's not as dramatic. If the yuan weakens too fast, China gets a domestic problem: capital flight pressure, import inflation, financial stress, and political discomfort. So one way China can support the yuan is by using reserves. That means selling dollar assets and buying yuan, or otherwise managing currency stability. This isn't a conspiracy, it's normal central bank behavior. But it creates this strange situation. Even if China doesn't hate the dollar, it still has reasons to reduce exposure and keep flexibility. So okay, China is selling. Gold is being stacked. The yuan is being defended. The West is nervous. Now comes the question everyone actually cares about. Is the dollar losing its grip? The truth about dedollarization. I'm going to say something that will calm you down and annoy you at the same time. This is a slow leak, not a blowout. There are real cracks, but the system is still standing. Here's the clean way to see it. The de-dollarization case and the dollar dominance case can both be true at once. Reserves down, but still won by a mile. Yes, the dollar's share of disclosed global FX reserves has drifted lower over the long term. And yes, headlines keep pointing out that it used to be around 70% decades ago, but look at recent official data. A Reuters summary of IMF COFR data reported the dollar share around 57.8% at the end of 2024. Think about that. Even after years of de-dollarization talk, the dollar is still well over half of reserves, more than the rest of the major currencies combined. That's not collapse, that's slow erosion. And slow erosion is still a big deal, by the way, because it changes the marginal buyer, but it's not a sudden switch off. Transactions. The dollar is still the world's operating system. If reserves are the savings account, transactions are the bloodstream. The Bank for International Settlements reported that the US dollar was on one side of 89.2% of all FX trades in April 2025. Translation: almost every currency trade still touches the dollar somewhere. And when it comes to cross-border payments, the RMB is growing, but it's still small compared to the giants. Swift's RMB tracker showed the yuan at 2.88% of global payments by value in June 2025, so the world can talk about alternatives, but the plumbing still runs on dollars. Trade. Some deals are moving, but invoicing is sticky. You'll hear headlines about BRICS trading in local currencies, and some of that is real, but trade invoicing is one of the stickiest, most path-dependent things on Earth. Companies don't want currency risk, banks don't want settlement chaos, and supply chains hate uncertainty. The Federal Reserve's 2025 review notes how dominant the dollar has been in trade invoicing across regions, especially outside Europe. This is why de-dollarization is hard. It's not a switch you flip, it's a network you rebuild. Why there is still no real replacement. Now let's address the thing people always skip. If the dollar is supposedly dying, why do central banks and institutions keep using it? Because being a dominant currency isn't about vibes. It's about infrastructure. A true reserve currency needs three boring, brutal qualities: a gigantic, liquid pool of safe assets you can buy and sell at scale, open capital markets you can actually move in and out of, legal and institutional predictability so investors trust the rules won't change overnight. The US Treasury market is still the only place with that depth at global scale, which is why the Fed keeps describing the dollar's international role as tied to market liquidity and the breadth of dollar-based finance. So let's talk alternatives, quickly. The euro. Big, credible, but the bond market is still split across countries, and political unity is always a question mark. The yuan, China is massive, but the currency is not fully convertible, and capital controls are real. That makes global investors nervous because they want the freedom to exit when they choose. Gold, not a payment system, it's a reserve asset. You can't settle payroll and global trade on gold bars without friction. Crypto, interesting, but volatility and regulation keep it from being a base layer reserve asset for governments. This is why the de-dollarization story looks dramatic in headlines, but slow in reality. You're not just replacing a currency, you're replacing an ecosystem. And the Atlantic Council's dollar dominance tracking basically lands on the same conclusion. The dollar remains dominant across reserves, trade, and transactions, even as some diversification efforts continue. So if that's true, what is China actually doing? They're not trying to blow up the system tomorrow. They're trying to reduce exposure to the system over time. And that leads to the next myth. China is dumping everything tomorrow. If China sold all its treasuries in a single dramatic wave, it would be punishing itself. It would push prices down, lock in losses, and potentially strengthen the very thing it dislikes, the narrative that the US is still the center of panic safety. So most of the time, selling looks like a slow blend of letting bonds mature and not reinvesting, shifting maturities, moving custody, and reducing net exposure gradually. That kind of exit is harder to see on a daily chart, but it is exactly how you move without starting. And it creates a weird paradox. The exit is slow enough that the world doesn't panic, but steady enough that the world has to adapt. Which is why you, sitting at home, should care. Because adaptation shows up in the stuff you pay every month. So if the dollar isn't collapsing tomorrow, why should you care today? Because slow changes create long, painful consequences, and those consequences hit your wallet first. Why this hits your wallet and your retirement? Let me paint the chain reaction. The US government runs big deficits. To fund those deficits, it sells debt. To sell that debt cheaply, it needs buyers. For decades, the foreign bid, foreigners buying US Treasuries, helped keep rates lower than they otherwise would be. So what happens if a major buyer reduces exposure? The answer isn't magic, the answer is price. To attract buyers, yields have to be more appealing. And higher yields in the Treasury market ripple into almost every borrowing rate in your life. Higher for longer interest rates. When Treasury yields rise, banks price mortgages, auto loans, and business loans off that baseline. So even if the Fed stops hiking, the cost of money can stay sticky. That's why you can feel tight money in the real world even when the headlines say inflation is cooling. You feel it when you refinance. You feel it when you carry a balance. You feel it when a small business stops hiring because credit got expensive. And by the way, foreign holdings shifting is not theory. Reuters has covered foreign demand and holdings changing month to month, including China's holdings sliding to around $700.5 billion in September 2025 in that long-run downtrend. Purchasing power erosion. Here's the part people don't like to admit. The dollar's strength isn't just because America is great. It's also because the world uses dollars. When more trade is priced and settled in dollars, the US gets what some economists call an exorbitant privilege. It can borrow in its own currency, and global demand helps absorb it. If that demand slowly weakens, the long-run consequence is that the US has to pay a higher price for the same borrowing. And if the US responds by printing more, you get the stealth tax, inflation. Not always hyperinflation, not a movie plot. More like groceries keep creeping up, insurance keeps creeping up, the feeling that your paycheck doesn't travel as far. It's death by 1,000 cuts. Market volatility in your retirement account. Most retirement accounts are basically two big buckets, stocks and bonds. People assume bonds are the safe part, but in a rising rate world, bond prices can drop. And in a world where the marginal buyer of treasuries is changing, bond markets can get jumpy. Now add the psychological layer. If markets believe the dollar system is getting politically riskier, you can get liquidity shocks, meaning prices move faster than people expect because everyone is trying to reposition at the same time. That's why these stories feel like macro nerd news one day, and then the next day your 401k statement looks like it got punched. The who buys the debt question, the real pressure point. When people argue about this topic online, they act like there are only two characters, China and the United States. In reality, the buyer base for treasuries is a whole crowd. You've got domestic investors, pensions, mutual funds, insurance companies, banks that hold treasuries as high-quality liquid assets, foreign central banks and sovereign wealth funds, and sometimes the Federal Reserve, indirectly influencing demand through its balance sheet policies. So the US doesn't need China the way a small country needs one lender. But here's the part that matters. Price is set at the margin. If a consistent large marginal buyer steps back, the market finds a new clearing price, and the clearing price is the yield. Think of it like renting apartments in a city. If one big employer leaves, the city doesn't disappear. But rents change, job markets change, and everybody feels it. Same logic here. Even if the debt gets absorbed, the terms can shift against you. A quick wallet math. Example, why 1% matters? Let me make this painfully practical. Say mortgage rates are 6% instead of 5%. That 1% sounds small until it hits reality. On a $400,000 loan, that difference can mean hundreds more per month. Hundreds. And if you're not buying a house, you're still paying for it. Landlords refinance too, and costs flow into rent. Same with credit cards, same with car loans, same with student loans. So when you hear foreign demand for treasuries is softening, your brain should translate it to the baseline price of money might stay higher. Why this can turn into a fiscal problem. Here is where it gets uncomfortable. As yields rise, the government's interest expense rises over time. And unlike your mortgage, the government doesn't just lock one rate for 30 years, it refinances constantly as bonds mature and new bonds are issued. So higher yields can create a feedback loop: higher interest expense, bigger deficits, more issuance, more need for buyers, pressure for higher yields. That loop doesn't guarantee disaster, but it does reduce flexibility. It makes every shock harder: a recession, a war, a banking problem, a natural disaster. And that feeds back into markets, because markets price not just today's numbers, but tomorrow's stress. Your retirement is exposed in two directions. A lot of people think their retirement is diversified because they own a target date fund, but those funds usually hold a mix of stocks and bonds. When rates rise fast, bonds can fall. When financial conditions tighten, stocks can fall. So you can get hit from both sides at once, especially during transition periods. And here's the sneaky part: even if markets recover later, volatility can change behavior. People panic sell. People stop investing. People miss rebounds. That is how macro shifts become personal loss. So if you want to treat this like a grown-up, you don't focus on panic headlines. You focus on the mechanism: who funds the deficit, at what price, and how stable the buyer base is. So the practical question becomes, what should a normal person watch to know if the slow leak is becoming a bigger problem? Part 6. The 5 signals to watch. No hype, just signals. I'm going to give you 5 signals, not predictions, signals. Treasury auction demand. If auctions start showing weak demand consistently, yields can rise without the Fed doing anything. The dollar share in reserves. If that 57-58% number starts dropping faster, the trend is accelerating. Gold and commodity accumulation. When central banks keep buying gold at scale, it's often a trust signal, not a fashion trend. Payment system share. If the RMB jumps from 2 to 3% to something meaningfully larger in SWIFT payments, that would be a milestone. The FX plumbing. If the dollar's share in FX turnover materially drops from the high 80s range, that's a regime change. Notice what I did there? None of this requires you to join a cult, buy a course, or scream collapse into a microphone. It's just watch the pipes. What a real blowout would look like. People love the word collapse, so let's define it. A blowout is not China sells another $20. A blowout is when confidence breaks in the rollover. It would look like multiple weak treasury auctions in a row, a spike in yields that doesn't calm down even when inflation data improves, the dollar falling while yields rise, a nasty combo, and emergency policy responses that feel like patchwork. And if you ever saw that, it would probably come with a narrative shift from rates are high because the Fed wants them high to rates are high because buyers demand a bigger risk premium. That's the line between policy and trust. Do I think that happens tomorrow? I'm not making that call. But I am saying this: China's strategy makes sense in a world where trust is becoming more political. And the Russia Reserve's freeze episode taught every major power to consider that risk not as a theory, but as precedent. The calm way to think about this. If you're watching this and your stomach is tight, here's the grounding idea. Currencies don't die like people. They fade like empires. And in the fading phase, you still go to work. You still pay your bills. You still invest. You just do it with wider eyes because the rules are getting rewritten slowly. So your job isn't to panic. Your job is to understand the incentives, track the signals, and not get emotionally hijacked by anyone selling fear for clicks. One more nuance before we wrap. Even if China reduces treasuries, that doesn't automatically mean the dollar gets replaced by the yuan. The yuan can grow in bilateral trade settlement, while the dollar remains the global collateral and FX bridge. That's why you can see two things at once: RMB usage rising at the margins, but still only a few percent in global payment traffic, while the dollar stays involved in nearly 9 out of 10 FX trades. It's not a zero-sum overnight swap. It's a slow reweighting, and slow reweighting is exactly the kind of process that sneaks up on people who only watch headlines. So, is the dollar losing its grip? Here's the clean answer. China reducing treasury exposure is real, and the latest treasury data shows China around 688.7 B in October 2025. The long-term reduction from the 2013 peak is huge. The motivation is strategic: sanctions risk, diversification, and domestic currency management. But the dollar is still the operating system of global finance, around 58% of disclosed reserves and near 90% involvement in FX transactions. So what's happening is not a sudden dethroning. It's a slow, strategic rebalancing. And the reason you should care is because slow changes can still grind down living standards over time: higher rates, more volatility, and a subtle erosion of purchasing power. Here's the story in one sentence: China isn't flipping a table. China is quietly moving its chair away from the dollar-centered table and building a second table across the room. And if enough big players do that over enough years, the US has to pay more to finance itself. That hits you, not in one headline, in a decade of tiny interest rate and price level consequences that add up to a different life. So I want to ask you something, honestly. Do you think this ends with a calm transition, or with a panic moment where everyone realizes the buyer base changed faster than expected? Drop your take in the comments. I read them. And if you want a follow-up, I can do the next episode on the hidden buyers question. If China is reducing holdings, who is replacing them? Japan, private funds, US banks, the Fed, or just higher yields?